Good morning students, welcome back to my channel. So today I am going to discuss few journal entries. Okay, you all know about journal entries? Yes or no, H.S.1st year students? Journal entries are the entries which are recorded in the books of original entry. Okay. So what is a journal? Journal is a book of original entry. Okay, so whatever transaction takes place, okay, on a day-to-day basis in a business are recorded in journal. Okay, so I have taught you the rules of American rules of recording transactions. Yes or no? In my last video, okay, you can check out. Asset, if it increases, it should be debited, and if it decreases, it should be credited. Liability, if it increases, it should be credited. If it decreases, it should be debited. Then you have revenue. If it increases, it should be credited, and if it decreases, it should be debited. Then you have expenses. If it increases, it should be debited, and if it decreases, it should be credited. Then you have drawings. If it increases, it should be debited, and if it decreases, it should be credited. So this is the American approach, okay, of recording transactions in the books of journal. Okay, so every accountant in every organization is doing, okay, is journalizing the transactions which are taking place. Now these transactions are recorded in the books of journal. How the accountant records? They see the voucher. Okay, they see the voucher. In the last class I have explained to you what is voucher. Yes or no? What is an invoice? Then sorry, invoice is a voucher. Then you have bill. Then you have receipts. So seeing this, the accountant records the transactions in the journal. Okay, so you know what is the American approach. Okay, you just check out my last video, and you have to know you have to have an idea of the various accounts. Okay, which account is to be debited, which account is an asset account, which account is a liability account, which account is a revenue account, which account is an expense account, okay, and what is drawings account. Okay, like cash account is an asset account. Then you have interest received, this is revenue. Then rent paid, salary paid, these are expenses. Liability, anything purchased on credit is a liability. Okay, so that is a liability account. Got it? So here you see I have taken few transactions, okay, in order to explain you journalizing. So it came in the year AHSEC 2021. AHSEC means Assam Higher Secondary Education Council from from Guwahati, Assam. Okay, those who are my like outside subscribers, okay, you all should know, okay, what is AHSEC, because you may be confused. AHSEC is Assam Higher Secondary Education Council from Guwahati, Assam. Okay, so it came in the year 2021, you see here, and it carries 5 marks. So what are the transactions given? It is 2019 December 1, started business with cash, rupees 40,000. Okay, so you see, and then the second transaction took place on December 2, that is purchase of furniture. Bought furniture means what? Purchase of furniture, rupees 5,000. Then you have December 3, that is 3rd December, you have purchased goods from Joshi on cash. Okay, since the name of the party is mentioned, okay, one may get confused that it may be a credit transaction. For that reason, cash is mentioned. Okay, the amount they have to, the amount is put. Then on December 4th, purchased goods from Joshi rupees 3000. Okay, this is a credit transaction because the name of the party is mentioned, Joshi. Then you have December 15th, sold goods to Naresh rupees 5000. Okay, sale of goods to Naresh. And since nothing is mentioned that goods has been sold in cash, okay, the name of the person is mentioned, so it is debtors. Okay, Naresh becomes debtors for the business, and debtors is an asset account. We know when asset increases, it should be debited. So you have to know the accounts. So take the first transaction, started business with cash. So here cash has been introduced into the business. So you all know that cash is an asset. So when it comes into the business, cash account, that is, okay, asset position, okay, of cash goes up, rises up. Okay, so it should be debited. And at the same time, capital of the business increases. We know when capital increases, it should be credited. Okay, so capital, when it increases, it should be credited. So it is credited. You have to write down the narration. Okay, being cash introduced into the business, amount is 40,000. Okay, then you see bought furniture. Furniture has been purchased. Okay, furniture has been purchased, and it is not mentioned that whether it is purchased in cash or it is purchased on credit. Okay, since it is name of the party is not mentioned, therefore it cannot be considered that the furniture has been purchased on credit. Okay, it will be considered that it has been purchased in cash. Okay, so here you see December 2nd, furniture. Furniture is an asset. You remember that furniture, building, goodwill, patent, these all are assets. Okay, furniture. Then land. Okay, so furniture here, it is an asset. Asset position goes up, so it should be debited. And at the same time, since furniture has been purchased, cash goes out of the business. Okay, cash goes out of the business, okay, on the purchase of furniture by payment of cash. So cash is an asset. Okay, so when cash goes out of the business, it decreases. So when cash is asset decreases, we know it should be credited. Okay, so it is credited. Okay, narration you have to write, being furniture purchased in cash. Okay, put the amount. Then you see purchased goods from Joshi on cash. Here goods has been purchased on cash. Okay, goods has been purchased on cash. Okay, so since the name of the party is mentioned, a student may get confused that the name of the party is mentioned, so it may be a credit transaction. But it is not a credit transaction because it is clearly mentioned that the goods has been purchased on cash. Okay, so what will be the entry here? Purchase account debited to cash account. Okay, purchase, you see, it is an expense. Purchase is an expense account. So when purchase increases, it should be debited. Expense increases, it is debited. And cash, again, it is an asset. Okay, when it is goods has been purchased, asset decreases, so it should be credited. Okay, it should be credited. Got it? Then you see purchased. Okay, you put the amount and write down the narration, that being goods purchased on cash. Then you see purchased goods from Joshi. Okay, since the name of the party is mentioned and in cash or not in cash, nothing is written. Okay, so from Joshi, name of the party is mentioned, so it is a credit transaction. Okay, so in that case you have to debit purchase account. Okay, It is an expense account. So we know when expense increases, it should be debited. Okay, so purchase account is debited to Joshi because here goods has been purchased on credit from Joshi, Mr. Joshi. So Joshi becomes a creditor. So when credit, okay, when liability increases, okay, it should be credited. Here Mr. Joshi is a liability, becomes a liability for the business when goods has been purchased from him. Okay, so here Joshi account should be credited. Okay, liability increases, so it should be credited. Okay, you write down the narration being goods purchased from Joshi on credit. Then you see sold goods to Naresh. Okay, goods has been sold to Naresh. Okay, so Naresh here becomes a debtor. Okay, we know debtor is an asset for the business. Here the name of the party is mentioned. Naresh here is a debtor for the business. Goods has been sold to Naresh. Okay, and immediate payment has not been received. Okay, since the name of the party is mentioned, name of the party is mentioned, Naresh. So it is a credit sale. Okay, the amount of the transaction will be received at some later date. Okay, so that is debtors. Naresh is a debtor. So debtor is an asset account. Naresh debtor is an asset account. We know when asset increases, it should be debited. To sales account. Okay, sales is again a revenue. Okay, sales is a revenue account. Revenue for the business. So when goods has been sold to Naresh, revenue increases. Okay, we know when revenue increases, it should be credited. Okay, it should be credited. Got it? So narration you write being goods sold to Naresh. Okay. So here you see cash is an asset. Asset account. Capital. Okay. Capital is nothing. Capital is a capital account. Capital account, when it increases, it should be credited. Sorry, and when it decreases, it should be debited. Furniture, it is an asset account. Cash, again, asset account. Then purchase, it is an expense account. Then cash account, it is an asset account. Again purchase, okay, I have written expense account. Joshi, here is a creditor. Okay, it's a liability account. Liability account. Creditor. Okay, Joshi is a liability account. Joshi here is a creditor. Okay, being goods purchased from Joshi on credit. So Joshi is a creditor. Then you see Naresh. Naresh is an asset account. Naresh is a debtor. Okay. The sales, you see Naresh is a debtor being goods sold, okay, to Naresh. So Naresh here becomes a debtor for the business. Money will be received from Naresh at some future date. Debtor is an asset account. Asset, when it increases, it should be debited. The sales account, it's a revenue. It's a revenue for the business. Revenue account. So this asset I have written, these all are Okay, I have just written to explain you. Okay, asset account, expense account, just to explain you. You don't mention in your exam copies, okay, these things, okay, in this side. Okay, don't mention all this. Okay, you just put the journal entries, okay, and give the narrations. Okay, narration means short description of the journal entries. Okay, and put the amounts, put the dates, put the dates. Okay, so see nicely. Okay, so we will be doing, okay, more journal entries in our next classes. Okay, I shall be doing more journal entries, okay, in my next classes. Okay, so I hope you have understood this. Okay, HS first year students, if you like my video, please subscribe to my channel. Thank you for today.